G'day everyone. Welcome back to the jungle, which is the January 2026 podcast with Scott and Phil. What is going on in the markets? And silver's going crazy, and we haven't even hit February.
Welcome to the new year.
Let's go. Okay, guys. So for today's podcast, Phil and I are going to go through a little bit of market volatility, what the next 12 months is going to be looking like, what conversations we're going to be having to our clients, and what you should be thinking about in relation to your wealth planning. Now, unfortunately, our crystal ball broke last week. So unfortunately, we don't know where the market's going to go, but we can certainly discuss some macro themes that we're considering. And I'm just going to kick it off. I have seen the news articles that there's going to be some inflation rates moving up. And with inflation rates, that means interest rates are also going to be going up. So that should be something that you should be thinking about if you are in a conservative portfolio. Rising interest rates tends to hurt those people who are sitting in bond portfolios, as those will hold longer dated bonds. It's a complex process, but should that actually occur, there's roughly a 4 to 6 month lag in which conservative and cash-based portfolios underperform the overall market. So that's just the first one that I'll be talking to people in my client conversations. What about you, Phil? What's the market's going to be affecting your conversations?
Yeah, it's interesting. I mean, just the ongoing unpredictability, I think, is a common theme that I'm chatting to people about. It's just that sheer unpredictability makes it bloody hard to know what markets are going to do. I don't know what the news is going to say tomorrow morning when I get out of bed. So yeah, it's wild.
I mean, in terms of European exposure, there's going to be probably a greater tilt towards European markets within the portfolios, just because there's going to be more movement. The European countries have a similar thing to the banks here. So the banks have got different Basel capital ratios. It's like 1, 2, and 3, which means if you're the Commonwealth Bank, if you're the ANZ or wherever, you have to hold a certain amount of liquid securities on your book. The way a bank runs is they basically take deposits and then they instantly send that out. That's fractional reserve lending, which we can go through in another podcast, and it's an entire PhD school of thought. But the long story short is that banks basically want to lend as much as possible. After the GFC in Australia, they put very clear mandates saying you need to hold certain levels of cash on your book, which is like tier 1, 2, and 3 tranches. In Europe, they've got a similar type of structure. And I will see that will be changing with the reduction in US treasuries being held. So they'll be selling US treasuries and potentially redeploying that across equities, alternatives, properties. So that's my pick for 2026. I think we'll see European infrastructure have some pretty strong tailwinds pushing into it.
Interesting. Yeah, I don't know. But the main thing I'm probably thinking about, aside from the ongoing volatility, so I think like interest rates is going to be an interesting one this year. We've already seen a couple of banks move their like 3 and 5 year fixed rates, which tells you that the banks are fairly confident we're going to start seeing the Reserve Bank move upwards. Interested to see what the fallout will be when we've got that combined with, the 5% deposit scheme for first home buyers. If you think that through, it probably means we've got a large amount of borrowers that have purchased property at insane prices, massive mortgages, very little equity, and probably at the lowest earning capacity they'll be in their careers because they're early on. It feels a bit like a perfect storm. I don't know. Could be wrong, but it's going to be interesting to watch.
So it looks like around 21,000 first home buyers from October to December use that scheme.
Yeah, right.
It's
a big number.
Yeah. So we've got 21,000 people have leveraged basically 95% into a property. And yeah, like you said, if you're buying at your lowest income earning years and interest rates start pushing up, that will then put pressure, plus also a ceiling on what price appreciation is, or potentially some price reductions too. Certainly what's happened here in Victoria.
Yeah. Higher interest rates just mean people can borrow less money. So it's got to put a cap somewhere. I mean, I don't know how we solved the housing problem. Still can't build enough. There's still not enough stock. So that's probably going to support prices somewhat, but yeah, I don't know. It's going to be some interesting tensions there. And like, you've only got to dig into a bloody comment section on Facebook of a news.com article about the direction of property prices. It seems like they've got a different idea every second day. There seems to be a very firm belief from a lot of people that property prices can never go backwards. And I would just point to, I think around the GFC, it was very real for a hell of a lot of people. They were in negative equity very quickly. 95% lends weren't uncommon before the GFC. And that flipped people into actually owing more than what their houses were worth. Very, very quickly. It's happened before. It'll happen again. It's, this stuff comes in cycles. I know it's hard to see at the moment, but yeah, we're just going to see how it plays out.
Hey, thanks so much for watching this video. Real quick, I've got Jordan, our client liaison manager. He's the one that's going to speak to you if you've got any questions in relation to your financial planning, your superannuation, or just what Wealth Lab helps people with. Book a meeting in the comments below. You'll be able to go straight into his diary. Or if you want to know more, you'll be able to speak to Jordan right here. All right, back to the video. So, okay, so just in terms of our general predictions, I'm saying European infrastructure, you're going to be talking about pressure, should we say, for those 20 odd thousand first home buyers that now have a 95% lend and potentially could be facing rising interest rates.
Yeah, increasing interest rates, yeah.
Yeah, I would say the next one would be not panicking. Globally, we have a natural growth, and that is going to continue no matter what happens. And there will always be silly things happening in the world. Geopolitical chaos is a consistent. It is the norm. It's just has different faces and different rises. So taking that for what it is, growth will continue, and allocating within a growth, balanced, high growth portfolio, taking a long-term view will yield great results, and not sort of paying too much attention to the ripsawing of markets. So I would say for that one as well, I think whenever you've got one pocket of chaos over here, you've got another pocket of growth. It doesn't matter where you're at, but a proper investor super portfolio that's invested in a mix of international, which is European, US, Aussie, equities, bonds, etc., will be able to ride that just natural growth, which just occurs within investment markets. And I would say, so my next one would be is just confidence in general equities. That would be my position that I'd be taking for the next sort of 12 months at least.
Yeah, and look, I think, it was only a couple of weeks back, just about every economist that you read an article from was saying actually we're feeling pretty good. Growth seems fine. You look at just released I can't remember the number now, but however many top research houses in the US, their predictions for 2026, and every single one of them was positive. Again, as usual, massive variance. One of them was like 0.26 positive, and one of them was like 15% positive, but all generally positive about the direction of markets and everything. And 3 days later, we're in a chaos of volatility, but that's normal. I was having this conversation over email with a client this morning that was just sort of, a bit worried about the volatility and what was going on. And of course, portfolio positioning and the level of risk you should take is a highly individual thing. And it's something we work through individually with our clients. So, don't run off and do anything based off what I'm about to say. But in general terms, when you think about it, the caveat here is that your portfolio is well diversified. It's well planned out. You're not investing in anything speculative. It's just a good old-fashioned, well-diversified, boring portfolio. You don't want to be trying to time the markets. You don't want to be trying to jump out when it's going to crash and jump back in when it's going to recover and all that sort of thing. And the reason I say that is because typically, not always, but typically, the best days that you have in markets are the days immediately following a crash. And you can't predict when that recovery is going to come. Often it comes very, very quickly and the recovery is quite rapid. So that's your best days in the market. And if you miss those best days in the market, the negative impact of that on your portfolio is much, much greater than what the positive impact of avoiding the bad days would have been. And to give an example, I'll pop up this chart here from Vanguard and some research put out by Vanguard. But, over the period of 2000 to 2025, if you're invested in the Australian stock market, I think they use the ASX 200, ASX 300 it was, so 300 biggest companies on the Australian stock market. Invested throughout that period, your average annual return was 8.2%. Just staying in the market through all cycles, through all the volatility and everything that went on. And that period included COVID, which was a pretty significant downturn for a lot of people. Could have been 15+% on your portfolio if you're in a balanced fund with a super fund. If you missed just the 10 best days throughout that period, your return dropped from 8.2% down to 6%. And you would have, had you run for cover at the bottom of the market when it crashed and you ran back out afterwards. If you missed the 20 best days in the market, your returns nearly halved. You dropped to a 4.3% return. And if you missed the 30 best days, you're down to a 2.8% return. So that very clearly tells you, as long as your portfolio is sensible, well diversified, well thought out, and not invested in speculative stuff, close your eyes, block your ears, ride the volatility. It'll sort itself out. But if you try and get clever and time the markets, you're more likely to stuff it up than get it right.
So I've just done the same thing that Phil was referring to, but you can actually change the number of best days. So if you were in the Aussie market, the difference missing out the 10 best days is dramatic. Starting with a $10,000 investment over this time frame, you can see the huge differences here. And then, for example, if we miss, say, the best 20 days, and this is consistent.
Yeah,
this is not.
It's a stark difference, isn't it?
It's a big difference. It's a huge difference because you're almost, so let's say 18th of October 2007, you've got your balance has gone from 10,000 to 23,000, and then to that 26, your balance is 26,000. You've literally made no growth in that time frame, missing just the top 20 days. So that is, what's that? 10 years is there. That's nearly 20 years. That's 3,600. That's in so that's 7,000 days of being invested If you missed the top 20, that's 7,300 minus 20 days. Look at the portfolio difference. It is crazy. And the benefits are retaining the investments. And this is consistent across, if we look at, say, Asian markets, I think it's more pronounced in the Indian market. There's greater volatility. Yeah. So there's a greater investment in the Indian market. They've just had a huge movement upwards as well. They've had a big capital inflow over the past sort of 3 years with their rising middle class, trading a lot more stocks. And the global looks quite similar to the Australian one. That's the difference. Yeah, the global's a bit different. So this is a really interesting chart that you can check out. You can just check this one out yourself. This is just fidelity.com.au, timing the market, which is really kind of interesting. So that's a good analogy showing if you're driving down the road, you've got 2 lanes, you change lane, try and faster, and all the cars move. And you change that way, and everything goes that way. That's just the example. We've all done it. We all know it's frustrating, but this is visually what it looks like. Should you do that with your money? It's very important that you are consistent and work with a consistent plan.
Yeah, and look, that's. I don't care how good somebody tells you, if they're giving you a sales pitch around their wonderful investment management skills or whatever, don't care how good they think they are. They are not going to accurately predict the bottom and the top of the market. It's not going to happen. Now, this is separate to what we talk to some of our clients about. We will take, different portfolio positions at different times, but that's going to be more a consideration of broader long-term macro events. We're not trying to get you in and out of the market at the top and the bottom. I can't read the future. I don't know what the newspaper is going to say tomorrow morning when I get out of bed. Yes, we do take portfolio tilts at times, depending on what's going on in the world. But, if anyone's telling you they can get you in at the top and out at the bottom and all that sort of stuff, don't believe them. Toki, the research backs it up. Close your eyes, block your ears, stay the course.
Correct. And I will say remaining invested is important, but also where it's invested does can add a little bit of alpha. For example, if you look at government bonds, so US government bonds versus Australian government bonds, they're yielding about the same at the moment. Where would you want to have your money? I would want to have my money in the Australian bonds because we are not inflating and poking people with nuclear weapons pointing back at us. So if you're able to get basically the same yield for a government bond versus US versus Oz, that's, for example, of portfolio tilts that are available to you as an investor. That's surely something to think about.
And everything we just said goes out the window if you're talking around, playing around with penny mining stocks and all that sort of stuff. Like, they may very well go to nil and not come back. So, sensible, big stuff. And again, this is not about trying to time the market, because we can't do that, but it is being prepared for what we know will come. And we know, we get a major crash every 7 to 10 years. Happens cyclically. The only thing that changes is the cause, but we know it's going to happen. So, if you're sitting here in your mid-50s and kind of getting retired, you're probably going to see that twice, maybe even 3 times before you drop off the perch. So you can't avoid market crashes, major macro events. They're going to happen. We know they will happen. So what you need to do is actually just be prepared to weather that storm. And so often what I'll talk to a lot of my clients about is just thinking less about their super as one big bucket of money, all my super sitting in the balance fund or the growth fund or whatever, and away we go. Thinking a bit more about what's the purpose and what are we trying to achieve with the money, and aligning the level of risk that you're comfortable to take with your needs, as opposed to just some arbitrary bucket that your super fund's lobbed in as a default fund. And what I mean by that is, you might think about the fact that you need money to live off for the next few years. Let's be kind of safe with that. Market crashes, cool. We're not forced to sell assets while the market's down because we've got this bucket to live off. And maybe this other money can be invested, still growing to keep you ahead of inflation, because we don't know how long you're going to live, but we do know with absolute certainty that every day you're alive, it's going to cost you more to buy stuff. So you need your money to grow to stay ahead of that. So kind of, just thinking more about aligning your investments with purpose coming into retirement. And that preparation needs to start a few years before you want to retire. Everybody I speak to knows somebody that was going to retire right before the global financial crisis and had to go back to work for another 5 or 6 years. And I don't want to have that conversation with my clients.
So I think it would be ensuring that, so we're seeing a few of our clients coming to us with a lot of cash and probably, in my view, too much cash. Some people have clicked it and there's that decision paralysis. If that's you, that's okay. But it's important that we spread the risk, not just have it sitting in I've seen some clients with I'm really conservative, and they'll have 50% of their portfolio in pure cash, and then the rest in Australian equities, which is 2% of the total world's market is the Australian market. And you're all in on this one tiny market, and you're like, I'm pretty conservative. That's an unoptimized portfolio. So diversification would benefit that type of investment portfolio. Dollar cost averaging, which is increasing your salary sacrifice. The great thing about our superannuation system is that we effectively are dollar cost averaging every time we get paid. Further salary sacrifice is a great tax deduction. It's something that you can do at any point in time if you have the budget for it. And just doing a passive market entry while there is volatility is a really good way on building long-term wealth.
Yeah. I love anything that's tax strategy too, because it's not relying on the markets. It's a known outcome. You play within the rules. You do it. You do this thing. You get this outcome. It's certain. That's nice.
Yeah. And ensuring that there's appropriate rebalancing within portfolios. So we did a pod last week on gold and silver. Some portfolios will have a really high allocation to what's referred to as alternative assets. And we go and watch last week's pod on our viewers on alternative assets. They're really difficult to quantify, but there's a big bucket. Gold and silver are an asset that sits in that asset class. It's gone up a lot. Whether it's going to continue or whether it's time to take profits and do an alternative rebalance, that's another strategy that would help grow wealth over the long term. So that's three things that in real terms that you can do with your portfolio to position yourself, not just for 2026, but for long-term wealth appreciation.
Too long didn't read version of all that is, don't try and avoid crashes. You can't plan for them. Plan for them appropriately. That's it.
Okay, so just before we wrap up, we're asking for you as a viewer for some questions. If you would like to hear us talking about something specific, please do get in touch. We are looking at the comment section, and you can just jump on the wealthlab.com.au website and you can book a meeting and ask some questions there. We want to make sure that you're getting value. We've got some wonderful feedback saying that we're giving away a lot of value, which is great because we are two guys on the internet just trying to share our thoughts. And if you've got anything that you'd like us to discuss, bearing in mind we can't answer your specific scenario on the pod, but if there's some high level questions that you're interested or some topics you'd like to hear us talk about, get in touch. That'd be great.
Yeah, I love meeting with you. I've met a ton of people off the back of this podcast, and I really enjoy it. So yeah, definitely book in for a chat.
Phil, is there anything else you wanted to talk about before we close out?
No, look, I think we've hit the key points. I don't want to muddy the waters too much. Like, yes, there's a lot going on in the world right now. Yes, the news looks a bit scary, but good investment fundamentals and good investment practice does not change. It has not changed in hundreds of years. So, follow the fundamentals, prepare for the worst. Don't try and avoid the worst because you can't, and you'll be fine.
All right, guys. Thanks for watching. We'll see you next week.
Cheers.